The dividend factor is not simply just buying the highest yielding equity securities. What an investor risks there are dividend traps, overconcentration in financially stressed companies. Dividend paying companies have shown resilience in volatile markets because that income portion of the return acts as a cushion. Dividends sit at the intersection of income quality and discipline.
Today, we're breaking down dividends, what they are, how they work, and how dividend strategies are actually built, specifically from an index perspective. Before we get started, just a quick reminder that we are not providing any investment advice or recommendations. Today's video, as always, is for educational purposes only. Joining me today is Paul Ricardella from MSCI, which is a widely recognized index provider in the industry. And Paul actually leads MSCI's index investing coverage across the Americas. So Paul, thanks for coming back to the channel. It's good to have you.
Erin, thank you for inviting me. It was a pleasure to be here.
Paul, let's start at, I guess, the foundation for viewers who might be newer to investing or need a refresher and are tuning in. When we talk about dividends, can you just explain what they are and how they work?
Of course. So simply put, Erin, a dividend is a portion of a company's profit paid to shareholders in cash. So if you own shares of the stock or if you own an ETF that's a collection of stocks, you participate in those payments. And all across the globe, dividends are paid on different cycles depending on the country that you're in. But typically in Canada, it's a quarterly cycle for dividend payments. And dividends are a really important part of an investor's total return in a stock because ultimately total return is price appreciation plus income. And so if you buy a stock at $100, you sell it at $110, you get $5 in dividends along the way, your total return is 15% over that period. And generally speaking, over longer periods of time, reinvested dividends have been a meaningful contributor to total equity returns.
Okay, awesome. So they're just a cash payment the companies are making to shareholders, really about sharing profits. What are the benefits of dividends that they bring to a portfolio for investors? Why are they such a popular approach?
So there are a handful of different benefits. I think the first is just the notion of income, right? For those that need income and want to do so without dipping into the principal of their investment, dividends provide regular, predictable cash flow for investors. And this is particularly important for retirees looking to build income streams. The second major benefit is that it brings a form of discipline by the company, meaning that companies that pay dividends have to generate real earnings to fulfill their dividend obligation. Management teams have to allocate capital responsibly. So it shows certain characteristics for the types of companies that pay dividends, which investors often find attractive as investment opportunities. And along similar lines, there's a degree of resilience that comes with dividend investing because markets are volatile. They go up, they go down based on geopolitical events and individual earnings and so many other unpredictable factors. Whereas the dividend payment is something that you can rely on that's quarterly, that allows you to sort of wait out the more challenging market environments because you know you're getting that regular cash flow.
Good explanation sort of in terms of what dividends bring to the portfolio. And, when we talk about income, we're really talking about cash flow. Compliance is going to have my head on that. So cash flow. And they also, as you say, tend to be a more defensive position in the portfolio. So in other words, they can play, different roles in the portfolio. Paul, when we talk about dividend as a factor, what are we really referring to when it comes to the index or the factor research perspective? Your wheelhouse, if you will.
So the key distinction here is that the dividend factor is not simply just buying the highest yielding equity securities. From a research standpoint, it refers to systematic exposure to companies with sustainable dividends. That's really the key. And clearly, as an index provider, it's our job to apply a rules-based selection And in doing so, we're looking to leverage academic research that over time has shown persistent characteristics tied to dividend paying stocks. And so I think the point is high yield alone or high dividend paying companies alone can be risky without any other controls. Sustainable yield backed by fundamentals and a well thought out index methodology is different. And so there is structure behind factor strategies, and that structure is what index providers bring.
So it goes beyond just sorting by highest yielding stocks and picking those. MSCI really does bring the structure and the methodology and the risk controls to the picture. Let's talk a bit about how the dividend factor compares or complements other types of factors. So factors, like quality, value, low volatility, momentum. We've talked about those a lot on this channel. How does dividends really fit into that family?
I would say that dividends have some overlap with quality, value, and low volatility. The overlap with quality is because quality tends to focus on profitable, stable earnings companies. By definition, to pay a dividend that passes our persistency screens, you really have to be profitable and have some earnings stability. It overlaps with value, which is based on reasonable valuations and effectively is the opposite of growth. If you think about a growth company, they tend not to pay higher dividends. They reinvest all of their cash in growth opportunities. Value companies and dividends have some overlap for sure. And then in terms of low volatility, the overlap is a function of mature businesses that are predictable in terms of their cycles. Now, the distinct feature clearly in dividends is the income component that we've already discussed. From a diversification perspective, dividend paying stocks are a great complement to either growth or momentum factor ETFs. And I don't want to get too technical here, but I say that because when you look at performance in different market environments over time, dividend ETFs tend to outperform in market environments where momentum and growth do less well, and vice versa. And so I wouldn't say it's about choosing one factor over another. Many portfolios blend exposures. Dividends sit sort of at the intersection of income quality and discipline and have some very attractive characteristics.
Okay, great. So they can definitely complement that growth or momentum style due to their lower correlation. They're gonna move differently, and that's what we're all looking for when we think about portfolio constructions and the benefits of combining asset classes that zig when others zag, if you will. Um, so, Paul, I want to get into a bit more around the index design standpoint because you've touched on, how you go beyond just picking the highest yielding stocks. But what are some of the key rules or screens that matter most from your perspective when building a dividend portfolio?
So in terms of only sorting by the highest yielding stocks, what an investor risks there are dividend traps, over concentration in certain parts of the market, and the potential to pick financially stressed companies. And so a disciplined index approach generally contains a few different dimensions like sustainability screens, earnings and profitability filters, payout ratio controls, and then, of course, any index must rebalance on a periodic and predictable basis. And so, specific important rules for the MSCI high dividend yield indexes include our dividend sustainability screen, which is effectively a rule that screens out extremely high payout companies, meaning that if you're consistently paying out 90, 95, 99% of your profits, at some point that becomes unsustainable. And so we have a rule that analyzes that. We have a dividend persistent rule that has a 5-year look back window at the consistency of dividend payments and the trajectory of those dividend payments. And then I think the third really important rule has to do with fundamental quality, where we rule out companies that have negative quality characteristics based on a return on equity screen, a debt to equity screen, and an earnings variability screen. So ultimately, Aaron, quality control is built into the process. The goal is sustainable yield, not distressed yield. And those three filters get it exactly that.
And that is really the beauty of index investing, those disciplined quality and risk controls that are in place for you. Talk to us a bit about historical performance, if you would. How does the dividend factor behave across different market environments, and how's it looking more recently?
Generally speaking, dividend paying companies have shown resilience in volatile markets for really the reasons that we've already discussed, because that income portion of the return acts as a cushion when things get choppy. In rising interest rate environments, dividend paying companies can sometimes face pressure, but strategies tied to earning strength tend to be more durable. So that can sort of go either way. And then in terms of inflationary environments, um, companies with pricing power can sustain and grow dividends. And so they tend to rise to the top of some of the screens that I was describing. Dividend growth can help offset inflation over time. And as you know, Aaron, in your work with us, MSCI has a ton of historic data tracing back to the founding of our firm in the late 1960s. And part of the analysis that we've done is we've looked at four states of the world: heating up, which is rising growth and rising inflation; Goldilocks, which is rising growth and falling inflation; slow growth, which is falling growth and falling inflation; and then stagflation, the worst scenario of all, falling growth and rising inflation. And what I can tell you based on that 50-year look back is that high dividend yield is fine in heating up, very slight underperformance. It's neutral in Goldilocks. It really excels in slow growth and stagflation scenarios.
Perfect. Yeah. So important to understand when you're evaluating a strategy that it might perform differently in different macro conditions. So that adding that context really helps. And I love the visual that you guys have and the way you've put it into those four quadrants. It makes it pretty easy to understand. Um, Paul, recently BMO listed ZDiv, which this is a mouthful, so bear with me, is a BMO MSCI Canada IMI High Dividend Yield Index, which tracks MSCI's index. So I'm hoping you can walk us through, do a deep dive sort of into the methodology around this new ZDiv ETF and the index that it tracks.
Yeah, certainly a lot of acronyms in both of our organizations, Aaron. So that was a mouthful. So ultimately, um, the BMO ETF and the MSCI index that it is linked to starts with an MSCI Canada investable markets index universe. And just, to frame this appropriately, that means an all cap universe. So large, mid, and small. At the moment, there's about 265 stocks in the MSCI IMI universe. Once we start there, we screen for companies with a high dividend yield relative to the broader universe. And to be specific, 130% of the yield of the starting universe. And so if MSCI Canada IMI has a dividend yield of 2%, you would need at least 2.6% as an individual company to make it through that screen. After that, we apply some of the quality metrics that I referenced, specifically return on equity, debt to equity, 5-year earnings growth. We look at the persistency, that 5-year look back window I was describing, and then the sustainability filters to eliminate payout ratios in the top 5%. All of that is done in an effort to avoid yield traps. Once we then have our final universe, the index is market cap weighted. And the biggest constraint that we have is that we don't allow weights more than 5%. And this is all in an effort to stay diversified. And then, of course, rebalancing is such an important part of any index investing process. Our index rebalances semi-annually. So when you do all those things, ultimately what you get is a fairly concentrated index with about 50 stocks, all of which pay sustainably high dividends. And at the moment, the total dividend yield in the index behind your ETF is 4.2%. And that's about 80% higher than the dividend yield for the MSCI Canada IMI universe. So ultimately, in the end, you get broad Canadian exposure, you get a rules-based approach, you get a very transparent methodology designed for sustainable income within Canadian indexes, within Canadian equities. And then it's important to note that any of the listeners can visit our website and do a deep dive on this index. Look at the historic performance preceding the live launch of the ETF, do whatever research they want to do to better understand the process here.
That's the beauty of ETFs, the track indexes. You can always go and look at the track record. Of course, when you're using that sort of as a point in your due diligence, you got to keep in mind that the ETF is going to charge a fee, and that'll affect performance as well. And of course, that historical performance does not equate to future performance. But I will highlight around that fee is that ZDiv is one of the lowest cost ETFs in its category. So we've launched it at 9 basis points, which is the management fee. So Canadians are really asking us for, broad total market Canadian dividend exposure, and they wanted it at a low cost. And I think we've really delivered with this new ETF. So whether you're newer to investing or, just refining that portfolio, I think it is important that you understand how dividend strategies are constructed and how they behave across different market environments. So I really appreciate you, Paul, for joining us today and bringing all of your great insights to this conversation. I hope to have you back again soon.
Yeah, it was my pleasure to be here. And I guess the last thing I would say, Erin, that's important for the audience here is that dividend investing has endured for decades because it's quite fundamental when you think about it, right? Companies generating profits and cash and returning it to shareholders. And obviously the market has evolved quickly, investment opportunities have changed, but that foundation has not changed, which is why dividends continue to play an important role in any portfolio.
The factor endures. Okay. Thanks so much, Paul. And we'll talk to you soon. That's all for today. Thanks for joining us, and we'll see you next time. Bye for now.